So, if you've spent any time at all looking into investing, I bet you've heard this advice a million times. Just invest in index funds. But what in the world does that actually mean? Why is that the advice everyone gives? And more importantly, how can it actually help you build wealth? All right, let's break it down and make it super simple. And look, this isn't just some random advice from the internet. This comes from Warren Buffett, literally one of the greatest investors in history. So when a guy like that says something is the most sensible choice for most of us, you kind of have to listen, right? So what is it about these funds that makes them so special? All right, so here's the game plan for this explainer. First up, we're going to tackle what an index fund actually is. Then, we'll dive into why they're so ridiculously popular. We'll cover a few of the most common types you'll run into, show you the mind-blowing power of compounding, and finally, we'll walk you through exactly how you can get started, like today. All right, let's kick things off with Section 1. The big question. What is an index fund really? The easiest way to get it is with a really simple analogy. Okay, think of it like this. An index fund is basically a giant shopping basket that's already filled with hundreds of different stocks. So instead of you having to go out and pick individual companies, like buying a share of Apple, then a share of Amazon, you just buy the whole basket in one go. You get a little piece of everything all at once. And the best part? It's all on autopilot. And the most famous example of this, the one you'll hear about all the time, is an S&P 500 index fund. Its only job is to automatically track the 500 biggest, most important public companies in the US. So when you buy one, you're essentially betting on the success of the entire American economy.
So what's actually in this S&P 500 basket? Well, it's pretty much every huge company you can think of. We're talking about Apple, Google, Tesla, Amazon, Microsoft. The list goes on. By owning just one share of that fund, you instantly own a tiny slice of all of them, plus about 495 others.
And this brings us to the most important word in this whole conversation, diversification. It's the classic idea of not putting all your eggs in one basket. If one of those 500 companies has a terrible year, it doesn't sink your entire investment because you've got 499 others to balance it out. This is the absolute key to why it's a much safer way to invest for the long run. Okay, so that whole idea of being simple and safe, that's the perfect lead-in to our next section. Why on earth are these things so popular? I like to call them the autopilot investment, and you're about to see why. See, most other funds have a manager, a real person who's paid a lot of money to try and be a genius, to pick the right stocks and beat the market. Index funds, they don't even try to do that. They are completely passive. Their only goal is to match the market. If the S&P 500 goes up by 10%, your index fund goes up by, well, pretty much 10%. No cleverness needed. And this whole passive, just match the market approach, well, it creates this incredible set of advantages, especially if you're just starting out. 1, you get that instant diversification we talked about. 2, the fees are insanely low because you're not paying some genius manager. 3, you get lower risk with proven long-term growth. And, maybe the best part, number 4, 0 skill required. You don't have to be an expert. It's perfect for just buying and holding.
All right, so let's say you're on board. You get it. But which basket do you actually pick? Let's quickly run through a few of the most popular types you'll see out there.
Well, you've got a few main options, and each one has a little code, a ticker symbol that you use to find it. The S&P 500, with tickers like VOO, is probably the most popular starting point. Then you've got total market funds, like VTI, which are even broader. They own a piece of the entire US stock market. If you want to invest globally, there are international funds like FXAIX. Or if you're really bullish on tech, there's the NASDAQ, ticker QQQ. Honestly, you can't go wrong starting with just one, like VOO or VTI. All right, now we get to my absolute favorite part. This is the real magic. Let's talk about the single most powerful force in all of finance, compounding. This is where investing goes from being a neat idea to something that can genuinely change your life.
Let's just imagine for a second. You decide to invest just $100 every single month. And we'll be pretty conservative and say you get an average return of 8% a year. That's actually less than the historical average for the S&P 500, so it's a totally realistic number.
Okay, now watch what happens. This is where it gets crazy. After 10 years, that $100 a month turns into about 18 grand. Pretty cool. But then the magic kicks in. At 20 years, you're at almost 60,000. At 30 years, it's 140,000. And after 40 years, that small, consistent investment has snowballed into over $350,000. It's not a straight line up. It's a curve that gets steeper and steeper.
And that is the whole secret sauce right there. Your money starts making its own money. It's not just your original $100 that's growing, it's the earnings on your money that start generating their own earnings. Your money is literally working for you around the clock. That's compounding.
So the big question is, how do you actually do this? Let's get into the final and honestly the most important part, taking that first simple step. And trust me, it has never, ever been easier than it is right now. You can do this all from your phone. There are tons of great, super easy-to-use brokerage apps. You've got the big trusted names like Vanguard, Fidelity, and Schwab, or you can check out newer apps like Robinhood or SoFi. They all make it incredibly simple to get going.
And seriously, the process couldn't be simpler. It's literally 3 steps. You open an account, which takes maybe 5 minutes. You search for the ticker symbol, like VOO, and then you tap buy. That's it. You're an investor.
And please, please do not think you need thousands of dollars to get started. Because of something called fractional shares, you can literally buy a piece of a fund with $10 or $5. The amount you start with is way less important than the fact that you simply start.
So look, if you take away just one single thing today, let it be this. Index funds are a simple, proven, and incredibly powerful way for pretty much anyone to build real, long-term wealth. It's truly investing for the rest of us.
So really, the only question left is, which one are you going to start with? Now that you know how simple and powerful this is, that first step is all yours.